people only see success for what it is now,
Mm-hmm.
as opposed to what it took to get there.
Mm-hmm.
People look at success and see the portfolio or the nice cars or the nice houses or whatever it is, and think, oh man, they must have gotten that overnight. Nobody gets success overnight. It doesn't happen.
Hello, everybody. This is Jake Stenziano, host of Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbo. Gino, how's it going?
Mr. Stenziano, I'm doing great. I'm excited for today's guest because we haven't connected. It's been a couple of years since we've connected. Mr. Azar has been on the podcast before, and he has grown immensely. He's got a little kid, which I like. I always like little kids. So without further ado, Jake.
He's got a hell of a beard going too, but I'm going to get formal here, Gene. I'm going to give a little formal. If they don't know John, so today's guest is John Azar. John is the executive vice president and managing member of MACC Venture Partners. He co-directed the company's recent growth from 2,500 units to over 6,500 units by developing a market brand and growing a portfolio of institutional and individual investors. So without further ado, John, welcome to the show.
Thanks so much. I appreciate it, guys. Wow, that was formal. That was,
hey, listen, I can button it up. I might have a T-shirt on right now, but if you want me to throw a tie on, I can do it. So
I like it. No, that's all good, man.
Yeah, John. I think the question for me is, how did you develop a brand, and how did that brand lead to your company's current growth?
Yeah, the brand is really, you develop a brand by working it. And working your relationships and developing and just being visible out in the market, day after day, week after week, month after month, year after year, and that's it. And just doing the right thing with the right people that you work with as you develop those relationships, whether it's with lenders or with equity sources or with people that are in the same industry as you, just like you guys, other syndicators or other sponsors. You are visible in conferences. You're visible in the marketplace, and that's really it. I mean, and really the biggest thing that we're proud of, that my brother Tony and I are proud of regarding our brand. If you ask anybody about MACC Venture Partners, hopefully the first thing that they'll say is we've never heard a bad thing about them. And I think that's the success for me for our brand is that you put in good karma out there, and hopefully you'll get good karma back, and people will know you for a good name.
At what unit level count do you think you said, hey, we need to create a brand and take it to that next level?
Yeah, it started out with probably right when we hit around 2,000 units or so, 2,500 units. We figured that this is something that's growing. And we needed to take it to the next level, the next inflection point, as I like to call. So, we are in our industry. I always refer to inflection points in our industry with anybody I speak with. And you do certain things in your evolution as you go through a different inflection point. You go through an inflection point, you realize you have to take your property management in-house. You go through another inflection point, you realize you have to kind of upscale your fundraising or your equity sources. You go through another inflection point, you really have to start rehiring people internally and look at your internal processes to get ready for the next growth period. And that's, so you have one inflection point around 1,500 units to 2,000 units. You have another inflection point around 3,000 units. You have another inflection point around 5,000 units or so. And you probably have another inflection point, which we haven't hit yet, which is probably going to be right around 10,000 units or so. And each one of those inflection points comes with their own set of processes and internal structures that you have to kind of reconfigure and tweak so you can meet the new company that you are becoming in your evolution.
So this is going to be important for the multifamily investors out there that are starting, even getting to the 1,500 unit point. What are the big, challenges when you're starting out? You're going to 1,500 units. What were those challenges that you guys faced to get to that point? Was it the financing? Was it the credibility? Was it getting those deals? What did you guys find that was hard in that first 1,500 units?
The first 1,500 is real. At that point, you're just really getting your feet under you. So you're becoming a legitimate entity, a legitimate known entity with lenders, with equity sources, with investors. I mean, at that point, when you're less than 1,000 units, not a lot of people know who you are.
Mm-hmm.
So the biggest challenge is really getting people confident and comfortable with dealing with you.
Mm-hmm.
Lenders are going to lend to you, but they're going to probably want you to sign, personal guarantee. It's not going to be a non-recourse loan. It's probably going to be recourse the first 1,000 units or so. Investors are probably gonna give you a lot more due diligence than they normally would. They're gonna want to meet you. They're gonna want to shake your hand. They want to see what you're doing. They're gonna want to hear about you. And it's gonna be probably pulling teeth the first few $100,000 that you get in the door.
Mm-hmm.
So it's but sticking to it and obviously making it through those first relationships is really pivotal, because as you continue to grow and get those relationships, that's what really going to start to differentiate you and make it a little easier on you. It's not easy. I don't want to misconstrue easier with easy, because it's never easy in our industry, but it will become easier as you become a better known entity with people you deal with.
So then you hit the 1,500 unit point. What happens at that point? Are you taking property management in-house? Are you starting to hire? Do you have more analysts on the team? What happens at that level?
Yeah, at that level, you can legitimately look into bringing property management in-house, which is what we did. And you start to develop that company around 1,000 units, 1,500 units. And you do start to maybe make some hires, not necessarily, you don't need to go crazy and hire a bunch of people, but you should definitely have somebody who's a controller or somebody who's in your accounting and start to you should have some kind of operation guy or gal. You should have someone in your start to do, especially these days now more than ever. I mean, when we were launched 11, 12 years ago, and we started in the multifamily 12 years ago, even 12 years ago wasn't really the same picture as it is today. The concept of social media and social media marketing and all that, I mean, that wasn't proliferated back then. So there's so many things now that you have to do that will make a bigger impact quicker than you would have back when we got started, 11, 12 years ago. So there are some of those levers that you might have to pull quicker now, especially in marketing, social media, getting the word out, getting your brand proliferation out there. Probably more so now than it was back 11, 12 years ago when we were first starting in the industry.
So you're at 3,000 units. What's that next inflection point at 3,000 units?
At 3,000 units, you're really re-examining and retweaking the way that you source capital, what source of capital that you are getting, who you are getting, what kind of structures you have to do to accommodate that capital. At that point, you probably should, if you have not already, into 3,000 units, you should definitely be integrating some sort of private equity capital or maybe smaller institutional guys into your mix, because you are big enough to where you start to attract that type of investor that are more sophisticated company investors, maybe even bigger family offices, as opposed to just the accredited high net worth mom and pop investors, which is probably what you've had up until that point, or maybe you've had already some private equity investors. After you've passed 2,000 units or so, which is what we started having. We started having private equity investors around 2,000, 2,500 units. But with that comes a set of expectations from those particular companies for you. So they want you to have, a legitimate deck. They want you to have a legitimate pitch book. They want you to have, some accounting structure inside, maybe some operations folks, who's handling your operations, who's doing your property management. If you're vertically integrated, which means you have your property management in-house, who is handling that? Do you have a team that handles your property management? So all these things have to be accounted for around 3,000 units.
And then you get
for
to
that
the
inflection point.
For that, the next inflection point, I guess, would be the 5,000 unit. What does that next inflection point look like?
That inflection point, you're going to have to, at that point, you're definitely working with private equity guys. You're definitely working with institutional guys as well. At that point, if you have not, you should definitely look at institutional guys, because you are going to be looking at also bigger deals, because you got to understand also the inflection point, not just from your own growth, but also your ability to absorb new units into your portfolio. So it's not just the ability to essentially write the check. Because look, some people who have 500 units can probably can write a check or find money to buy, 1,000 units overnight. But the question is, can you absorb those 1,000 units overnight as opposed to just writing a check? So it's not just the money portion in our business. It's also the ability to manage and absorb correctly and legitimately into your portfolio, which is that 5,000 units. At that point, you're at that inflection point. At that point, hopefully you have processes and levers in place in your own company to be able to absorb quickly, have a team that is ready to onboard your new assets quicker into your portfolio. And obviously
unpack that a little bit more, John, because I think people may not be necessarily resonating with that, because you're at a certain point and you take on, say you get a 500 unit deal done.
Mm-hmm.
There's a lot of moving parts to that, and that absorption and making sure that you're hitting your numbers. What are some of the pitfalls that you've seen, taking over a larger asset, even as you've had scale?
Yeah, the biggest thing that we did and which we still do is we've instituted a transition team that all they do is absorb new assets into our portfolio. So that transition team is usually consisting of anywhere between 2 to 5 people. And their sole job is to go to those assets that we buy, whether it's a portfolio of assets or one asset, and make sure that they bring those assets on board with us, into it. Since we're vertically integrated, their job is to make sure that their software is up to date and they are installed. Vendors. We use, as far as our property management software, we use Entrada, to make sure that Entrada is installed on all the computers, to make sure that they are trained on using Entrada, and new vendors, the new sources of raw materials. We buy roofing and wood material from this person, so let's make sure that we that translates to that site.
Signage, repositioning. It goes on and on.
It goes on and on. Signage, repositioning. Handymen that are working in property. The whole 9 yards. Licenses that are supposed to be in place. Marketing that's consistent with our brand marketing. So it goes on and on. But there is a transition and absorption period that lasts anywhere between 1 month to 3 months to absorb units into our portfolio. And the better transition team you have in place, the quicker you're going to be able to absorb, and the quicker you're going to be able to start making money and meet your underwriting criteria. Which is also, by the way, something we share with all our team when we take on a new property. So our transition team is in charge of implementing our underwriting to that new asset. Mm-hmm. Not necessarily from the standpoint that you think about, our property management folks and our work crew don't necessarily need to be finance expert. They don't need to understand our underwriting, but they do need to understand that, hey, we've budgeted 10,000 units for roofing. Make sure you don't exceed $10,000 for the roofing. Mm-hmm. We've budgeted, $20,000 for a marketing program for this year. Your job is to make sure we don't exceed that $20,000. Hopefully come underneath it. So it's not that they need to understand our underwriting. They need to understand the numbers and why we're asking those numbers. Because if we hit those numbers, they need to understand once we hit those numbers, we're going to be able to make profit. We're going to be able to generate more distributions, and we're going to be able to give them bonuses. So they are incentivized by meeting those goals.
So you're talking about at the 5,000 unit. I think all the syndicators out there need to listen to this, because it's nice and sexy going out and doing deals. But if you don't have the infrastructure, and as Jake likes to say, if you don't have the people, the systems, and the culture within your organization, you're not going to hit those targets. It's going to be a lot harder to absorb a 500 unit asset. So which John's telling you, as you go through these inflection points, you start growing and growing and growing. 2 questions that I have. What is your favorite inflection point? Where did you go, wow, this is awesome, this is my favorite part? Which one did you enjoy the most?
I think 3,000 is when we realized that, hey, we have something pretty cool on our hand, and we are no longer small potato. So I hate to say it. Not that we're big potatoes, but we're no longer we can legitimately walk into institutional guys' offices and say, hey, we can probably do a deal, we can absorb it, we can manage it, we have the infrastructure. I can walk into some of the big institutional guys in New York's offices and say, we can play at that table.
Mm-hmm.
And I think that's why I like that inflection point a lot. And plus, I like it because this is the first time when we started to kind of reorganize ourselves internally. And anytime you look at yourself internally and start to reorganize and bring new people on board and bring new processes and new systems on board, that's when you really start to get excited that your growth is really adding on to something.
So when
so that to me was the most exciting inflection point.
When you look back, let's go through a couple of mistakes you made, especially early on when you first started out, because I think a lot of investors out there don't look at multifamily as a business, and you guys obviously do. And that's why you've been able to hit these inflection points and continue to stack on and continue to grow and grow. What were some of those mistakes you made when you were a lot smaller?
Yeah, we continue to make mistakes. We're not impervious to mistakes.
But they're different. They're different mistakes now, though. I would say the mistakes are different. And when you're bigger, they're a lot different. When you're smaller, I think most investors, the problem is they don't have the end in mind. They don't think I want to grow to this point. I need to start implementing systems. I need to have property management software. I need to bring property management in-house to a certain point if they're not doing it themselves. So when you're small, you can't, it's linear. You can't see out into the future, right? That's the thing. So because I can tell you, Jake and myself, that's what we did. We didn't have proper property management software. We weren't hiring properly in the beginning. We put up with a lot of nonsense from employees, and we didn't have core values. We didn't have a mission statement. We didn't have a culture. I wish we had that a lot sooner. When we were smaller, we would have been able to grow a lot quicker. We should have gotten an analyst a lot sooner. Those are a lot of the mistakes we made. Jake, any other mistakes?
Yeah, you don't know what you don't know, man. I mean, we jumped into it. I mean, John, so for us, we went in at 25 units and just started self-managing a 25-unit deal, and just bootstrapped it from the ground up. So it was a little bit different of a story, but I think it's everyone's got a different path, and hindsight's always 20/20, but I don't regret any of it. I think it would have been great to have better systems initially, but that was the big thing for us.
Mm-hmm.
Well, that's the thing. I mean, you do what you can at the time that you can. So it's not, you can't. What works for me is not necessarily going to work for you or somebody else. But for us, probably not bringing on someone like an analyst earlier on or an underwriter in house was probably a mistake, because we took on a lot ourselves. Between my brother Tony and I, we're doing a lot of the stuff ourselves. We're doing my brother was doing the underwriting and looking at the properties and visiting the assets. And, both of us were on the road all the time and then coming back and crunching the numbers, where if you have someone else doing at least the number crunching for you, that would make it a lot easier. So you can, make the decisions a lot more easier to do, a lot more linear. So that's one thing. Probably putting too many eggs in one basket as far as our work crews are concerned. We depended on one or two people too much, and we paid dearly for that mistakes. Because unfortunately we got burnt really bad with one guy who turned out to be pretty much a scam artist, and took a bunch of people's money and didn't do the work and didn't do the materials. So you're going to learn from all these things, unfortunately, but you got to vet your people out better. You got to vet the people out that you're working with better. Just because they're the cheapest doesn't mean sometimes that it's the best way to go. Sometimes when somebody gives you a ominously cheaper price, you got to look at that price and say, damn, that is really cheap. Why is it that cheap? What's behind that? It's if they're coming in 10-15% cheaper, that's one thing. If they're coming in 40% cheaper, then you got to look and say, okay, what the hell? Who's he stealing from to be able to give me 40% cheaper price?
I like that. So you have basically had the I'm a mentality. I'm gonna do this and I'm gonna do that, and that's what we had when we're smaller and entrepreneurs. And it's hard to let go. It's hard to really say to yourself, okay, now I need to start hiring. And that's one of the things I think in entrepreneurs have that problem is, when do I do that? And I think everyone listening, write down those inflection points that John's talking about, because they're really important, and map yourself out. When you're starting, don't think of yourself as just a mom and pop. Think of yourself as growing and getting into a business. That's why we all want to get into multifamily, to be able to grow a business like this. Wouldn't you agree, John?
Yeah, absolutely. Absolutely. You definitely got to think of yourself as the next step. I mean, look, always when you're growing, always kind of reverse engineer your growth. Think of where you want to get to and reverse it back and look at what you need to get there. So if you want to get to 10,000 units, then reverse engineer it. What are people at 10,000 units doing? What do they look like? What are they doing? What do they have in place? And then people who are 6,000 units, what do they have in place, or what are they doing? And people have 5 and 4 and 3 until you get to whatever you are. Whether it's 50 units that you own now and you want to get to 100 units. So always try to sort of reverse engineer the process. And the biggest thing I'd say is reach out to other people in the industry. If this is a small industry, as big as it seems, it's still a pretty small world. And for the most part, hopefully, maybe I'm just an optimist, but for the most part, hopefully people will be able to help you, and they don't mind helping you and giving you guidance and help and feedback. And those who don't, then you know what, screw it, move on. This industry there are no secrets in the industry. There's no secret sauce. The only secret sauce that people have is their own work, their own dedication, their own hustle, and your own way of trying to get things done and accomplished. There's no, just because I share with you how I do things or how I do my underwriting, doesn't mean that you're going to go out there and compete with me and it's not pie. There's plenty of pie for everybody. Just because I do my underwriting a certain way and I share it with you, doesn't mean you're going to eat the rest of my pie. I mean, that's just not the way this business works. But unfortunately, there are a lot of people who think like, oh, well, it's mine. I'm gonna hoard this material. I'm gonna hoard this information, and if I don't share it, then nobody else will get to be successful and compete with me, and I'm gonna be the only one who's successful. And that's complete bullshit. That's not how it is.
Well, listen, that's the old school mentality. My dad, God rest his soul, he never really told me his cheesecake recipe. Do you know that? He would always leave it a little ingredient out. The old schoolers, they thought there was like the proprietary, dude, it's cheesecake, Dad. Just tell me how many cups of sugar you put in a thing. And it's the abundance versus scarcity mindset. That's really what it comes down to. And if you have an abundant mindset, you're going to grow to 5,000 units. If you're scarce and you're holding on to every last dollar, nobody's going to want to do business. And I think John says something really important when he first started out. He does what he says and he says what he does. And you cannot find a bad thing about MACC Capital. That's right. So do people want to do business with John and his company? Yes. Or when he puts in an offer, is he going to be able to close in that deal? Yes. So that's how you become successful in any business. It's by sharing, by working with others, by helping others. And then all of a sudden, a deal comes in across the desk. John can't do it. Hey, let's partner with Jake and Gino and share the wealth, because the pie is not finite. The pie is infinite, and there's always people making money. It's not the stock market where it's a zero-sum game. There's always somebody out there who can create value with these products. So with multifamily, what I wanted to ask you, John, asset selection. Have you changed your asset selection or your strategy since you've been growing from when you started to where you are now?
Absolutely. Yeah, absolutely. We definitely have. I mean, we've stuck to certain things. I mean, we have always been a value add shop. So we've stuck to sort of the value add equation. We've stuck to how much we want to spend on units when we take them on, how much we're comfortable spending, how much we're not comfortable spending. So that hasn't changed necessarily. I mean, the numbers may have been tweaked a little bit. We've changed, target markets. Obviously, we've expanded our target markets. We've changed even the class that we're looking at. So we typically used to, early in our early days, we used to look at C+, B, sometimes B minus. Now we'll look at B plus, A or A minus assets as well. We didn't used to look at new construction. Now we look at new construction. We didn't look at, going into a deal where there's a brand new development deal with a developer. Now we do. So there are a few things that we have started definitely adding on to our portfolio in the way that we do things that we didn't do before. We've started instituting sort of vintage as to what vintage we're comfortable with. I mean, right now we really are not comfortable doing anything below late 80s vintage. If it's after 87, 88, 89, we'll look at it. But beyond that, we'd be pressed to look at something in the mid 80s and before. It just doesn't. There's a few things there is reasons why we don't look at assets below mid, especially here in the Southeast, that are mid 80s and below and older. Mainly the piping, the electric grid, and really the construction. So we hate poly piping. When we see anything that has poly in it, that's a big turnoff for us. And poly piping stopped being implemented in any construction in 1987. I think 1986, 87 they outlawed poly in construction. So if you look at anything beyond 87, it should not, for the most part, have any poly piping. And then of course you have aluminum wiring or copper wiring for electric. And a lot of the older than 80s, some of them did have aluminum piping, and aluminum wiring, and that got also outlawed beyond after 1980. And most assets beyond the late 80s will hopefully have copper piping and more proper electric grid. So these are just some of the reasons we started kind of changing the way that we look at assets.
So would you say also the way the where capital's coming from? I mean, your capital sources now really aren't attracted to the older assets. The capital sources you're getting now, whether it's private equity or higher institutions or family offices, they probably want the nice looking assets. They don't want the 25 unit crack den that Jake and I started out with. They want that 192 unit Class A property that's maybe at a 3.5, 4 cap with maybe a 10% pref rate, something like that, something that's a little bit less riskier. Would you say that that's been part of the evolution also?
Yeah. I mean, they definitely have their own criteria. I mean, we're that's not to say we're not still dabbling into some of the C plus B minus assets. We still certainly are. But yeah, we are, depending on the size of the assets and what we're looking at. So we also have to cater to where the equity sources have to be. So if I'm looking at an asset that's 100 units in my backyard somewhere here in North Carolina or South Carolina, then I don't mind what it is. I mean, we'll take on the work and we'll absorb it. We'll probably do the money ourselves, and it's a small deal. It's not a big deal. If I'm looking at something that's 250 units in the greater Atlanta area, then I better make sure that that's something that has the criteria that some of our institutional investors will want. So I can't just say, well, screw it, I'll just do it however I want. It's you can't do it the way they want. If you're depending on other people's money, you've gotta cater to what they are looking for and what they want. So yeah, you have the freedom to decide on whatever you want to add to your portfolio, but at the same time, if you're constricted by other people's money, you got to make sure that you hit those criteria. And it's better for you too, because it gets easier. When you look at assets that are 2000 vintage and newer, your due diligence is going to be easier. Your maintenance is going to be easier. Deferred maintenance is going to be easier. Your capex is going to be less. So there are a lot of things that you're going to give up that are going to be easier, make life easier for you anyway.
I love that. So last long answer question: do you have any tips on raising capital? I mean, when you first started out, must have been challenging raising capital. As you start growing, what tips do you have out there for the listeners to raise capital?
Just be consistent and again, look at those processes and see what your target market is looking for. I mean, the biggest lesson that I've gotten out of raising capital is you have to sometimes cater to what those capital sources are looking for in you. Are they looking for you to have a specific pitch deck? Are they looking for that pitch deck to contain a certain amount of pages? Do they want 10 pages to 20 pages? Do they what are you doing internally that they want to see? You have an accounting department, you have a marketing department, you have an operations group. And then also just consistently always, be meeting people that are, don't raise capital when you need it. The biggest thing I would tell you is do not raise capital when you need it. Raise capital when you don't need it. Meaning you don't necessarily have to get the checks, but you have to build the relationships when you don't need them. And that's the biggest thing I did for many, many years when we first got, when we got started, from 2014, 2015 until about 2018, I was just getting relationships done. I would go out and I would be on the road constantly for a couple of years just to meet people in New York, Boston, Dallas, Chicago, wherever. I would just go knock on people's doors with some of the bigger private equity shops, institutional shops, and say, hey, I just want to meet with you. And I don't have anything right now, but I'd love to start a relationship. I'd love for you to get to know me. Here's who we are. Here's our story. Here's where we want to get to. And for the most part, they would say, that sounds great, John. Let's, come in. Let's meet up. When you have something, when you get to that point, when you have a project, when you get to a certain size, give me a call. I'd love to do a deal with you. That's what you want to do. You don't want to go hit equity when you have a deal that's hot on the burner and say, oh shit, I got to find 10 million bucks. Where am I going to go for that? So that's the wrong time to be raising equity because, people are not going to move that quick.
I love that. So you couple that with the branding that you guys have done, and then you have gasoline on the fire, the branding and the hard work. Excellent.
Yeah. All right, guys, let's take a quick time out to hear from our sponsor.
Are you looking for ways to improve your life?
Here at Jake and Gino, our mission is to empower students through financial education and the vehicle of multifamily investing.
Yes, Jake. We agree that a person with financial intelligence can change the world for the better.
We've created our proprietary 3-step framework, buy right, manage right, and finance right, that we teach to our community. This framework, along with education, our one-on-one mentorship, on-site boot camps, and the amazing community has propelled our students to massive success.
We've all been there. We've had so many students that have been able to shift their mindset, overcome limiting beliefs, and set a clear path to achieve their goals. Whether you're currently fixing and flipping, wholesaling, or buying single-family rentals, and you know that multifamily investing is the right vehicle for you, I encourage you to visit jakeandgino.com/apply to schedule your complimentary consultation with our team. And I want to let you know this isn't a high-pressure sales call. It's really just a discovery call to get to know each other better and see if we're a good fit for working together. And if for any reason we're not a good fit, our team has tons of resources we will share with you to help you along your journey.
If you're ready to stop spinning your wheels, go to jakeandgino.com/apply and schedule your call now. All right, we are back. John, what is your best habit for success?
Best habit for success. Just show up, be consistent, show up more than not showing up. I mean, showing up is that's the old adage. Showing up is half the battle. I mean, really, show up, whether it's meetings, events, conferences, podcasts, or meeting with people. And the biggest thing, I think earlier we're talking, Gino was talking about his dad's cheesecake recipe and some of the old school thinking ways. The only thing I'll tell you from old school that is still applicable to today is stand by your word. I mean, when you give somebody your word, just stand by that. Don't back out. Don't try to backpedal. And if it's something you don't think you can do, then don't do it. If it's something you think you can do, then try your best to do it. And it's the only thing that I would say from old school is that you try to institute still to this day.
And even working hard. I think working hard nowadays is frowned upon sometimes. It's like the 4-hour work week and, you're just working smart. I think we all need to work really hard to ultimately learn how to work smart. So that's something that I think is really should be instilled in all of us.
Oh, absolutely. I mean, look, people only see success for what it is now, as opposed to what it took to get there. People look at success and see the portfolio or the nice cars or the nice houses or whatever it is, and think, oh man, they must have gotten that overnight. Nobody gets success overnight. It doesn't happen in a flash. There's always a lot of hard work and a lot of dirt to get you there. So you got to go through the dirt to get there.
You said something earlier which was pretty cool, and there is a lot of great folks in this industry. I mean, we've met some, through the podcast and the events and things like that. There's a lot of hardworking people, and there's a lot of great folks in multifamily. So it's
absolutely
something. Yeah, it was like, I don't know why. I just it was like, you don't hear that often, I guess. So it's a great space.
There are a lot of great people in the industry. There are a lot of great people who are willing to help, and that's what makes them great. Who are willing to lend some of their wisdom or lend their helping hand or. For no reason other than just to be helpful, not because they have a vested interest.
Well, Jake, I think realized early on that in real estate, everyone gets to eat, right? Whether it's the attorney, the CPA, the broker, the property manager, the owners.
Big table, man.
So I mean, if you come out from the big table and you look at it that way, I mean, it's a pretty cool business to be in.
It is. Yeah. It really is. I mean, there's a lot of players in our business, a lot of different moving parts, a lot of different arms, and that are gesticulating all over the place. But they're, hopefully they're all working together and they're all helping each other out.
John, what is your best tip for someone scaling their business? I know we dove into this, but is there one thing where you can say when you're starting to scale, this is what I recommend people to do?
Again, we did talk about on it earlier. Make sure your internal systems are in place. Make sure that you can take on that scaling. Again, it's one thing to say I can afford to scale, or I can or I have the checkbook, or I have the equity, or I have the money behind me to scale. And it's another thing altogether to have the systems in place internally to allow you to scale. Just because you can write a check for 2,000 units doesn't mean you can manage 2,000 units. That's completely two different things. So, and it's gonna backfire on you. You know, you go out and buy 2,000 units, you don't know what the hell you're doing. That'll be the last 2,000 units you buy.
And we've all seen it. I mean, we've shopped deals that guys have had, and they've had portfolios of 2,500, 3,000 units, and you're walking the deal, and you're looking up, and there's damn gardens growing out of the gutters. And it's like, they don't have a system in place to make sure their gutters. It's like just one of those pet peeve things that I see. It's like, guys, you fucking gutters are falling off the roof, and you have nothing in place for that. So it's you see it where they're going fast and hard, getting ahead of themselves, and the assets are deteriorating. So we've seen that as well.
Yeah, absolutely. But at the same time, it's to the benefit of other people, and it's pretty Darwinian in this business. So whoever gets in over their head and fail is somebody else's fortune. I'm not gonna lie, it's an opportunistic business. I mean, as all these good things that we talked about, also it's at the end of the day, it is a business. So if somebody fails to manage it properly, their 1,000 or 2,000 units, there's going to be somebody else on the other end who's be happy to take those off their hand at a good discount and put a good value add on it and make more money than they will.
Any books that you've read recently that you'd like to recommend?
Recently, right now I'm reading a couple of different books that are not necessarily about our business. I read a lot of nonfiction. I'm reading a book called Quackery. It's about the history of the worst ideas to cure everything. So it's in this environment of
cool.
It's about like the old snake oil salesmen, and what kind of stuff they used to sell. How
they used to bloodlet you, they used to cut you, they used to bleed you, and they thought
exactly. Exactly. All these things. How opium used to be given to babies, to soothe their pain. So that kind of stuff. So it's pretty cool.
Opium, Jack Daniels. I mean, they used to give kids all crazy shit, right?
Oh yeah, absolutely. The other book I'm reading is called The Invisible Hook. It's about the economics of pirates, like old pirates. How pirates back in the 1600s and 1700s, like Blackbeards, used to have actually pretty rigid economic systems and business structure.
They did
what people think.
Yeah, they had actual teams. They had a sort of discipline that if they didn't do something, it was really structured back then. It was really wild to think about. You think they'd be unorganized, they have no discipline. They were actually run like a business. It was pretty cool.
Oh, absolutely.
Yeah, because here in St.
They even had a pension plan back then, believe it or not.
Come on.
I didn't know that. Yeah, I didn't know that. In St. Augustine, they have one of the biggest pirate museums here. So I went in there. I was like, dude, it's really interesting to think about that. Because listen, you have a head, you have the guys who run the ship. If you don't have tight control over them, they're crazy to begin with. They're young, they're old, they're all over the place. If you don't have that tight control, you're not going to be making money. And it's also, hey, listen, it's a rough business. You make one mistake, you guys are all dead. So if you don't have that discipline to take care of the ship, man, it is going down, my friend.
Yeah. So I don't know this for sure, but I've been watching The Last Kingdom, that Netflix show, and absolutely loving it. And it seems like there was, if you look, the Danes versus the Saxons, it seems like there was a lot more upward mobility with the Danes versus the Saxons. So that's maybe they had a few things right. So
the Saxons wanted to hoard the information. The Dane wanted to give the information away and just keep growing. That's what we like. We're multifamily is more like Danes.
I love it.
I like that.
All right. What project are you excited about right now?
So a couple of different projects we're working on. We're launching a fund towards the end of the summer, early fall, that's going to be a sponsor fund. So it's going to be a fund that's going to be targeting sponsors and syndicators, like you guys or like us. So we're kind of switching the tables, taking the other side of the table where we will provide, equity funding and come in as, either co-GPs or LPs on projects. And that's going to be US wide. So it's going to be nationwide target. It won't be like our usual strategy, Southeast. We're going to be looking at sponsors across the United States. Right. So that's pretty exciting. I'm really, really excited about our fund. The other thing that we are launching is a coaching program. It's going to be a tailored coaching program for multifamily only. And that's going to be pretty sort of custom made and tailored to people who want to grow their business, whether they're in a, again, certain inflection point, want to get to the next one. You know, if they're starting out, either they're starting out at 20 or 30 or 50 units, and they want to get to 1,000 or 2,000 units, or they're 1,000 units and want to get to 3,000 units. You know, we're launching a program for that as well. Actually, it's already launched. We have already launched that program.
So if someone wants to start knocking on your door about the fun, like you used to do in Chicago, what's the best way for them to get a hold of you? You don't got to give out your personal address, but you have an email or a way for folks to get a hold of you?
Oh, absolutely. Yeah. I mean, they can always email me, John, JOHN at maccvp.com, maccvp.com. And I'm happy to even give out my phone number on it, so they can reach out to me via that as well. 617-519-6211. They can always hit me up with that as well. Or obviously find me on social media, whether it's LinkedIn or Instagram or our website at maccvp.com.
Gino, it's always refreshing to get a guy on that's actually doing it and in the business, getting his hands dirty with a little vertical integration. Much respect to that. Gino, you got anything else before we hop off today?
Well, I just want to go real quickly through the inflection points. You have the 1,500, the 3,000, the 5,000. I want everyone to go back and listen to the different inflection points in John's learning lessons or learning curves. He's been doing this for almost 3 decades now. So he's been doing it for a long time. And it resonated throughout. Hard work, just hard work and continuing to scale. And you're going to make a lot of mistakes. You're going to get ripped off. It's okay. Take the long view, Jake, right? Just take the long view. And
100%.
What's the amazing thing is you're going to evolve, right? You're starting to buying a certain type of asset, certain type of place. And then all of a sudden, as you grow, you're going to be able to see that you're buying different assets, buying different types, different vintages, and also reverse engineer it. Know where you want to go and then reverse engineer it. Maybe do a 1 year, 3 year, and 5 year plan for yourself and see where you want to go. And I think ultimately, Jake, remember what we say, revenue is vanity, profit margin is sanity, and cash is king. The most important thing I think that John said is don't scale just to scale, just to say, I want to get another 500 units. It's great. It sounds sexy. Jake likes to say be on Instagram. It doesn't really matter. That matters nothing in life, because if you're buying just to buy, but you don't have the infrastructure or the systems or the ability to manage that, you're a fiduciary to people's money. If you can't handle it, you can't do it, and all you're in it for is fees, then you're in the wrong business. You're out there. You have a responsibility to your family, to your partners, to your investors. So don't scale just to scale. Make sure you're growing for a reason and you can handle that next jump. So those are the big learning lessons that I took, Jake.
Awesome, dude. I love it. John, really appreciate you coming on today, and best of luck in the future.
Thanks, John.
Absolutely, man. It's always a pleasure having you guys. That's awesome. Thanks for having me.
Thanks,
man.